Hey, what's up, guys? My name is Carlos, and today I'm going to be breaking down three stocks I think you should buy this week. Okay, so as I said, we're going to be going over three stocks today. But before we begin, please make sure to subscribe to my channel and like this video. That's going to help me a lot, and I'm going to be bringing you guys a whole lot more content moving forward. So let's begin. The way I'm going to do this is very simple. I'm going to give you three stocks. Each one I'm going to describe for 2 minutes, so let's put the timer, 2 minutes on the clock. And basically the way I'm going to be ordering it for you guys is I'm going to start with the least risky stock, so the one I feel strongest about that will maintain its value. Then I'm going to move to a stock that has a little bit more risk, and finally the third one is going to be the riskiest stock. And even though it is the riskiest stock, I want you guys to know that I feel super confident about this stock. I would not be pitching it to you guys if I thought it was a trash company, because it's not. I just think it's a lot more risky. That's why I'm going to do it in this order, just so you guys kind of have an idea. Okay, let's get started. So the first stock we are going to be talking about today is CVS, and let's get the clock rolling, and boom. So CVS is a pharmacy. It is a very popular pharmacy. Its competitors are Walgreens, and I would not call it much of a competitor, but I guess Friday you could throw it in.
Bro, you're trash, bro. Is them tears?
CVS, I don't know. But anyway, CVS is right now trading at $70.50 a share. Its price per earnings ratio is 12 compared to the broader market S&P, which is 25. So what does this tell you? It tells you that it is massively undervalued compared to the S&P. And why is it undervalued? There's a lot of reasons why people think it's undervalued. Personally, my take is that in 2018, they acquired this health insurance company called Aetna. Aetna was very expensive. It cost them almost $80 billion to get, and this really affected their balance sheet negatively. Their debt right now, their total debt is up to $170 billion, but their total assets are $213 billion. So they have more assets than debt, which is great. Another reason I feel bullish about this is because in 2020, a pandemic year, guys, there was a whole pandemic in 2020, and they still managed to raise sales by 5%. They had $256 billion in sales in 2019. For 2020, they had $270 billion. So what does this tell you? It tells you that the company is growing. It tells you that the acquisition of Aetna was actually a very smart investment, because CVS gives you a lot of, household items. It gives you a lot of medicine when you're sick, and they also provide people with prescriptions. They now own a health insurance provider. So this is just going to ease their way into offering clients more health insurance plans, helping them get better prices for their prescriptions. And I think there's going to be a lot more growth for CVS moving forward. Another reason I'm bullish on the stock is because right now everybody's going to begin taking their COVID vaccines. The clock is over, but we're still going to keep going. And anyway, more people are going to be coming into CVS because CVS is going to be one of the major distributors of this COVID vaccine. So it's going to force more people to go into the stores. Naturally, when people go into the stores, they might buy more things, which will raise their sales. One of the risks of owning CVS, is their high debt. This might cause investor sentiment to be low moving forward, but don't worry. I think this is only temporary. So if you buy in and the stock doesn't move a lot in the short term, don't worry. I think it is going to be a great long-term investment. On top of that, they pay a 2.5% dividend. So you're still going to be making money even if the stock stays flat. All right. So our next stock is going to be J&J. Let's get the clock rolling, and boom, this stock is another vaccine play. Today it is trading around $161, give or take. The market is open right now. Their price to earnings ratio is a little high. It is 29. As we said, the broader market right now is 25. So it is a little overvalued right now, but I don't think this is any reason to worry, guys. The reason being is that this is a huge vaccine play. They are awaiting FDA approval for the vaccine that is supposed to be, the approval process is supposed to be done Thursday. It can be approved as soon as Friday. So this is going to be a massive, massive positive for the stock. The reason being is because even though they won't profit from the stock in 2021, they can start beginning to profit in 2022. They are going to be selling the vaccine for the same price that they that they paid to produce it in 2021, but once everybody's vaccinated and people think this is going to be a recurring vaccine, they can up the price and start making profits on it. On top of that, they already have a very stable business. They offer a lot of baby products. They offer a lot of self-care products like Aveeno, Neutrogena. I'm sure you guys are very familiar with that. They also offer Tylenol. Everybody takes that when they're sick. And on top of that, they are the creators of Band-Aid, like the actual Band-Aid brand. Like, they are the owners of that. Everybody I know uses Band-Aid, so I mean, this stock is not going anywhere. Their sales are not going anywhere. And on top of that, they also pay a 2.5% dividend. And it's also even known as a dividend king. So that's just a fancy way of saying they've been paying a dividend to their investors for over 50 years, guys. That's huge. You know you're going to get a dividend with them. And if you look at the chart, they do have steady growth over the years. So this is just a great investment overall. In 2020, they were also able to increase sales from 82 billion to 82.5 billion, which isn't much, but we were in a pandemic, guys, and they were producing a vaccine. The risk, okay, clock is up, but the risk, real quick, for the stock is that they might have volatile price movements due to the vaccine rollout. We saw Pfizer and Moderna also have very volatile quarters when they rolled out their vaccines. That is my biggest risk with J&J. The revenue is going to be there, and the vaccine might even bring future revenue. So this is a great stock. A little bit more risky than CVS, though. Okay, guys, and finally, our third stock. And in this one, we are talking about clean energy fuels. Remember, this is the riskiest one, but I would not pitch it to you guys if I didn't think it was a good investment. So let's start the clock, and boom, this one is trading at around $14 today, and it's actually pulled back massively from its all-time highs, which is $19. But you must note, this is a very volatile stock. During the crash, during the beginning of the pandemic, and when there was a huge stock market crash, it crashed all the way to $1, and it's gone all the way up to $19 in the past 52 weeks. So that 52-week low dollar, 52-week high $19, that's very volatile. And right now it's at 14, so it's somewhere closer to that 19, which is where I think it'll stay. But why is this big? Because right now their price to earnings is 87. They are massively overvalued compared to the broader markets. But why do I also like the stock is they actually have earnings. They actually, are profitable compared to their competitors, other renewable gas energies. They're not even profitable yet. They have massive amounts of debt. This one actually has been making strides to become a leader in the industry. So a little bit about what they do is they make renewable gas, right? And how do they make it? They basically get waste from farmers. Very disgusting. Very, very disgusting stuff. But they find a way to make it into energy. And, trucks, large fleets, buses, they use this type of stuff. Then towards the end of 2020, they were able to make partnerships with Chevron, with BP, with Total SE, and even the LA Metro company. So all the buses in LA, yeah, they're going to be using clean energy fuels. Like their fuel, their renewable gas, that's what they're going to be using to charge those buses. That's huge, guys. Their revenue did go down in 2020. They report Q4 earnings next month, but up to Q3, their revenues were down from 224 in 2019 to 216. So this is a risk. Personally, I think it was due to the corona pandemic. Not a lot of people were using trucks at the beginning due to lockdowns. So I think this will pick up. As I said, they have huge partnerships with BP. Clock is done, but fuck it. I'm going to keep going. Anyway, they have huge partnerships with BP and Chevron. What does this tell you? These are energy stocks. These are, stocks that, work with oil. They produce oil, all that type of stuff. And if they're investing in renewable energy, what does that tell you? That tells you that there is going to be huge demand for this going forward. Like I said, this is a super risky stock, but I think over the long term, demand is going to win out. I think renewable energy is a very lucrative industry / sector, whatever you want to call it. And I think that for investors who are looking 5-10 years down the line, this stock is going to massively outperform the market. But like I said, the biggest risk right now with the stock is that it is very overvalued by PE metrics, which I don't think means much right now in the market, but it's just a way to gauge valuations right now. And yeah guys, I think it is a great investment. I would not be pitching it to you guys if I didn't. But anyway guys, I really hope you liked this video. If you did, don't forget to hit the like button, and if you're looking for more recommendations every week, don't forget to subscribe. I will be dropping weekly recommendations, and this is my first video, so I'll see you guys in the next one.